We're in the face of a market shakeout. How should we react in the short term? What will happen to the price of Bitcoin? We'll tell you all about it in our technical, fundamental, and on-chain analysis. This is of interest. Stay until the end. The merge. MT Gox 42,000 Bitcoins, the hunt for Do Kwon, the rise of CBDCs, the max exodus of crypto CEOs, the President of the United States petition to streamline regulations surrounding the crypto market, the European Parliament and its vote in favor of the use of the blockchain, the MiCA law. There's been a lot going on that has impacted the price of Bitcoin and other cryptocurrencies lately. Also, what are the consequences of the macroeconomic data? We're about to collapse. Bank of England interventionism comes into play. France will spend 100 billion euros on fighting inflation, or making it worse. Credit Suisse almost went bankrupt. Credit Suisse CDS hit highs. The International Monetary Fund's future doesn't seem too bright, and the three most important economies in the world, the European Union, the United States, and China, will continue to cool down, doomed to a recession. What does the future await? The IMF has warned, the worst is yet to come. That said, let's kick off with a technical analysis. As we can see in this weekly time frame, in the week starting June 13th, a swift movement led Bitcoin's price to an oversold area on the RSI, something that has never been seen before. From that moment on, we've moved into a lateralization phase. After that fall, the price found itself in a mini range which broke on the upside in the week starting July 18th, after which it went on to test the relative maximum of this lateral phase, touching a resistance located in the $25,000 area. Looking at the moving averages, we can see how in the fall carried out in the month of June, the 200-period moving average was lost. It managed to gain that average in mid-July, attempting to consolidate in a very relevant resistance zone, which converged with an important intermediate trend line in price, although was rejected. In that time frame, we can get a view of events that had never occurred within Bitcoin's price. It missed the all-time high from the previous cycle in 2017. Additionally, it missed the 200-period moving average and even crossed the 20-period moving average, something that had never happened before. In mid-August, we can observe a drastic drop once again. In the week starting August 15th, we can see a bearish engulfing candlestick, which lost the 200-period moving average and attempted to close below the support, located between $21,500 and $22,500 approximately. The following week, the movement was confirmed, the support was lost, and a new lateralization period began, which lasted 4 weeks. The bearish engulfing candlestick from September 12th to 18th indicated a continuation towards the downside. The next 3 candlesticks illustrate the indecision of the market, forming a gravestone doji candlesticks in 2 of the 3 weekly candlesticks. This week, which is not yet closed, we have seen an important movement, which is developing a type of dragonfly doji candlestick. The opening started on the downside and led to a clear setback. The connotation will be seen when it closes and opens the following week. Now it is looking to close above the current resistance placed at $19,500. As we can see on this chart, there's kind of a bullish divergence on the RSI, which could hint at something. If so, we would see a significant volume growth, displaying harmony between effort and result, which would break the current pattern. On the other hand, we also see a divergence in terms of volume, contrary to the RSI. These mixed signals make it difficult to accurately determine the directionality of the action price. If you're enjoying our content and would like to see more videos like this, please like and subscribe to our channel. Don't forget to turn on the notifications. In the daily time frame, we can see the current lateral mini range we're in since September 14th. Here we can see the important resistance located at $20,500, a value that has been sought on several occasions and that has been rejected on all of them. If we look back, we can see how since the resistance of the $25,000 area was lost, a kind of minor downtrend has formed. We can see how the September 21st candlestick touches a very important area. This area between $18,140 and $18,530 has served as a key floor, where the price has bounced back up several times. At that time, the price bounced back and headed towards the resistance at $20,500 on October 4th. This is followed by a downward movement that on October 11th marked a low below the bullish structure that we were beginning to see. In October, the minor bullish trend line was lost, and on October 13th, the price gravitated towards the important resistance zone where it bounced back, forming a long lower shadow candlestick with a bullish connotation, indicating buying interest in that area. The movement carried out on October 13th has caused what could be seen as a bear trap derived from a long squeeze. So what is a long squeeze? This occurs when there's a rapid decline in the price of an asset due to a technical or external factor. During that time, important macroeconomic fundamentals were released, and we'll be covering those shortly, so be sure to stay until the end. Watch out though, because it could be a short-term movement. What is clear is that it is a shakeout of the market in both directions derived from liquidations. In this chart, we can see the volume profile or visible range. This displays the buying and selling volume in a specific price range. We can see how the $19,000 area is very important when it comes to Bitcoin's trading. This red line seen is the VPOC, volume point of control, or the highest volume concentration level within that profile. In other words, it represents the most accepted price by both the buyer and the seller. When the red line was reached on October 13th, it took effect and that area wasn't lost at the close of the market. The support between $18,100 and $18,500 is proving to be a very important support zone. The price is attempting to close with a bullish engulfing candlestick above the $19,700 area. We'll have to wait and see whether it succeeds. If so, it would go on to test the next relevant figure at $20,500. To see the minor downtrend line break apart and the relevant resistance previously marked, we would have to see strong volume input and an attempt to consolidate. Should the price not sustain above $19,500, we could see a further pullback heading towards the aforementioned lows between $18,100 and $18,500. If the fall continues, the price would move on to test the next one, located at $16,000. This chart represents the dollar index. In it, we can see an ascending macro range trend or ascending parallel channel that has been going on since 2008, which indicates the great strength of the dollar against other currencies. A major trend line has formed, which is subdivided into minor trend line and has been marking constant highs and lows throughout this time. It seems that the dollar index is looking to consolidate its position in the upper part of the macro range. If it succeeds, it could gravitate towards its 2002 highs. Here, we can see that we could be facing an ABC movement. It looks flat, which could indicate this corrective move, which boosts pairs against the dollar, like how Bitcoin pairs help the equity indices. Failure to consolidate above the 110 or 111 point area could lead to the area of the minor bullish trend line, in what is known as a three-wave pattern. In the case of supporting this downward movement, it could hint at a possible continuation towards the upside. In the SP500 chart, we can observe a movement similar to that of Bitcoin. On October 13th, it opened on the downside, reaching the 3,500 point area, an important support for the SP500. Upon arrival, it bounced higher and sought to break the resistance located at 3,700 points. Its value is flowing with a minor trend line. In addition, we can see how there is a clear divergence in both the RSI oscillators and in the wave trend. This could be a sign of a possible reversal to the upside in the short term. Should the minor trend line win, we may be looking at a double bottom pattern and see a continuation to the upside. This would take place if the price manages to break the next resistance at 3,800 and perhaps see a throwback, breaking the confluence with the intermediate trend line to then try and gain the 3,950 point area and go looking for the 4,100 point as the highest point, which converges with the main trend line. If, on the other hand, the price fails to consolidate the breakout or even fails to break that minor trend line, the move would continue the pattern, a sort of descending triangle or wedge, and continue to look for the supports it has. The news stemming from the United States is not exactly positive. Following continuous restrictive policies and the hawkish approach of the central banks, we're starting to see a global economy cool down. Although PMIs display a downtrend, the data predicts that the Fed's hawkish approach will continue even at the risk of a recession. The ISM manufacturing PMI released at the beginning of October registered almost 50.9%, a worse than expected figure displaying a clear contraction. The S&P Global Manufacturing PMI came in at 52%, slightly better than expected, although it does confirm a global contraction trend. On the other hand, the ISM Services PMI displayed better than expected expansion, 56.7%. The S&P Global Index followed in its footsteps and resulted in 49.3%, improving forecasts. All of them maintained the main downward trend. However, their data reinforces, in the short term, the Fed's rate hike, because for the most part it is above 50%. In terms of the labour market, one of the most important pieces of data, and one that has direct impact on consumer spending, as well as, consequently, both inflation and GDP, is that of non-farm payrolls, which is better than expected, as it supports the aggressive stance of the Fed. It went up to 263,000, above 250,000. To this, we must add the unemployment rate in the United States, which sits in a good place, 3.5% better than expected and displaying full employment. The Producer Price Index, the PPI year-on-year, presents an increase to 8.5%, 0.1% more than expected. This is a negative figure, although the core sits at 7.2%, 0.1% less than expected. As for the CPI, this data represented an increase of 8.2% instead of the expected 8.1%, a negative figure, and the core sits at 6.6%, 0.1% worse than expected. The monthly CPI is negative, minus 0.4%, double the expected. The core sits at 0.6% instead of the expected 0.5%. In short, as the data indicates, everything remains the same, and the minutes of the meeting of the United States Federal Open Market Committee seem to reiterate so. At least in the short to medium term, the Fed will maintain its hawkish stance. Inflation is their priority, and although we are beginning to see the economy cooling down and signs of recession derived from this historical rise in interest rates, according to the Fed, this is not enough. After seeing how their predictions have already changed 3 times in a year, predictions that are getting worse and worse, together with JP Morgan, do you think the damage of the rise is already done? And considering that, although we may be facing inflation, we do not see how it subsides. Are we really, as many economists have affirmed, facing stagflation? It certainly seems like the worst is yet to come. In the Eurozone, as we already know, the European Central Bank has lagged behind the Fed in raising rates and has not been able to initiate quantitative tightening, in other words, the reduction of its bonds balances. This has somewhat weakened the euro against the dollar. And why aren't they carrying out QT? Nobody wants to buy debt from countries such as Spain, Italy or Greece, especially after the anti-fragmentation mechanism, or TPI, the tool used to stabilize the risk premiums of peripheral debt. Basically, buy more debt. Added to the energy crisis is the financial crisis derived from the fiscal stimuli in the form of aid. And as if that weren't enough, Germany has launched a joint fund with the European debt to deal with the energy crisis as long as the aid that is destined for member states arrives in the form of credits and not in the form of transfers. Interventionism and indebtedness is in an environment of over-indebtedness is not the solution, and far from it. It usually leads to inflation, as we will see shortly in the following indices. Looking at the Eurozone CPI, preliminary data was released on September 30th, marking historical data. A rise in inflation to 10% compared to the expected 9.7%. On the 19th of this month, revised data will be released, although it already seems like this runaway inflation won't subside. The producer price index data is alarming, 43.3% compared to the forecasted 43.1%. This data is not at all reassuring and in fact very high compared to the previous year. A fact that of course has impacted the euro, causing it to depreciate. Now let's take a look at retail sales in the Eurozone year on year, which is 2% versus a forecast of 1.7%. Another worrying fact that reflects how the economic contraction is devaluing the euro and creating a recessive environment. And here's two additional pieces of data. The Eurozone manufacturing purchases PMI, which is worse than expected, sitting at 48.4% instead of 48.5%. And the Eurozone services PMI along the same lines, with 48.8% instead of 48.9%. Now that we've covered the negative fundamental data, let's move on to the on-chain analysis. The Fear and Greed Index illustrates extreme fear, a deterioration since last week. Here, we can see that exchanges' reserves continue to drop, reaching incredibly low levels not seen since July 2018. In the short term, we saw a boost in these reserves that preceded a price correction. And as we can see from October 30th to October 1st, it experienced an increase, which represents the price correction that took place. Although we can see another drop that has encouraged this rebound. The exchange net positions change is an indicator that measures the net amount of Bitcoin going in and out of the wallets across all exchanges. When the value of the indicator is negative, the net number of Bitcoins leaving exchange wallets is greater than inflows. As we can see here, in line with the exchange's reserves, the indicator turned green from September 12th to October 9th. This refers to a greater entry of Bitcoin and, as a result, a price correction. Once this correction took place, we can see how the indicator transitioned into red. The distributed phases can compensate for now as supply continues to exceed demand. Moreover, despite the hash rate and the difficulty of mining increasing the security of the network as seen on our Twitter account, miner capitulation has continued. This has not helped price action as it has redistributed these trends and basically led to a new price construction. As we can see, from August 6th up until today, balances have fallen due to that capitulation, from 1.86 thousand to 1.85 10,000 Bitcoins. In other words, sales are being rewarded above what is being generated before the accumulation on behalf of miners. To stay up to date with the latest news and data, follow us on social media. Details are in the description box below. The $19,000 area holds the largest buying and selling volume and is an area that we are attempting to evade. If that were to happen, it would lead to a distribution scenario that could initially push the price into the $16,600 zone, where the next relevant zone is located. And if that weren't enough, it could even drop down to $13,600, coinciding with technical support. The price realized by age displays the average price at which the current unspent Bitcoins were bought, belonging to each category of holders. As the chart reveals, short-term 3 to 6 month holders are already priced below longer-term 1 to 2 year holders. This usually indicates the possibility of capitulations by long-term holders, as seen in the following indicator. As Glassnode highlights, we can compare the average purchase price per currency of the cohort of short-term holders against long-term holders to approximate relative stress levels. The continuous depreciation over a prolonged bear market is causing the realized price of STH to fall below the realized price of LTH. This market structure indicates periods such as the last 155 days in which those who are new to the space have a better cost base than those who have weathered months of volatility. This is a direct result of the capitulation of LTH. Currencies bought close to the top of the cycle are sold and change hands at much